we create expense plus contra account, which is accumulated depreciation. Why we create on contra account? So that we know that how much we use the assets or how much is the wear and tear due to the usage of that equipment with respect to its lifetime. If asset is used, its useful life is 5 years, and we know that how much we have in terms of dollars, how much we have used these assets, right, from time to time. It also tells you that, oh no, okay, this is now time is coming to replace that asset. So entry would be depreciation to accumulated depreciation. That is, you just remember by heart that, okay, whenever there is a depreciation, entry would be depreciation expense to accumulated depreciation. E, other manufacturing overhead cost incurred during October, which means we need to create a liability. We are not paying yet, we will pay later. So we create liabilities. So other expenses belongs to manufacturing overhead. So entry would be manufacturing overhead to accounts payable, right? Understand? Min, Aroni?
Yeah.
Yes.
Okay. And then here, the company applies manufacturing overhead to the production on the basis of 8 per machine hour. A total of 30,000 machine hours were recorded. So this is applies, which is applied manufacturing overhead, right? So applied manufacturing overhead is written on the credit side of the work in progress, on the manufacturing overhead, right? So entry would be work in progress to manufacturing overhead, which is applied, right? Understand? Christine, Chandra, Min, Arone? Applied is written on the credit side, actual is written on the debit side. So that's why I remember this one. And now the G is the production orders costing 520,000 according to the job cost sheet were completed during October and transferred to finished goods. It means 520,000 worth of goods is now completed. Like we transferred raw material to work in progress, and now we are transferring from work in progress to finished goods. It means work in progress is going to be decreased, that inventory, and finished goods inventory is going to be increased. So entry would be finished goods increased, assets increase, finished goods, debit, work in progress, asset decrease is going to be credits. So finished goods to work in progress. And now production order that has a cost of 480,000 to complete order to their job cost sheet were shipped to customer during the goods. The goods were sold on account or at 25 above the cost. It means among these 520,000 worth of goods, 480,000 worth of goods being sold, and they keep their gross profit 25%. So it means this much worth of finished goods had been sold, right? This is a sale price, 480,000. Chandra, Min, Arone, Christine, this 480,000 is the sale price or it's the cost?
Cost.
Yeah.
Right? And this 520,000 is the cost or the sale price of the finished goods? This is also the cost, right? When this is also the cost, it means we can easily decrease this 480,000 worth of finished goods, right? So it means It means whenever sale is happen, two entries are going to be needed. One is sales, right? And one is decrease in finished goods. Because you sale, what happened when sale happened? The sales department or marketing department, record the entry, and the costing department, they also make the entry. From costing department, finished goods is now transferred to sales. Finished goods decrease, sales increase. And sale belong to owner's equity, right? Owner's equity increase, credit. So sales increase mean credit, right? On the other hand, the expense, so these are the costs, because cost is going to be, decrease from, like, income statement is sale minus all expenses. So this 480,000 is the expense, right? Because that is your cost of making the goods. So expense increase, expense will be recorded on factory side, sale will be recorded in marketing department. So there are going to be two entries. One belongs to decreasing the inventory, because that cost belongs to some expense. So expense increase, debit, and decrease in finished goods, credit. So here expense is the cost of goods sold, finished goods decrease, which means credit, right? So cost of goods sold to credit. And the next entry would be marketing department sales entry. Sale happened 25% above, right? So 480,000 multiplied by 5% above. It means the sale price is 600,000. When sale occurred, the question didn't say that we received the cash. If we didn't receive the cash, we create customer. So customer to or account receivable to sales, right? That's it. So how we make the T accounts? So you see manufacturing overhead. If you want to make manufacturing overhead, so just identify the manufacturing overhead account entries. So account entries would be, first of all, manufacturing overhead here, which is 12,000. It is debited, so 12,000 here. Then here, 110 debited. Debited mean left hand side. So this side is called debit. This side is called credit, right? And also we have manufacturing overhead 40,000 debit. Yes, debit. And then we have manufacturing overhead 70,000. 70,000, right? And then we have manufacturing overhead credit to 40,000, right? Now let's balance this. So it means the credit side is 8,000 bigger than the debit side, right? So over applied, under applied, we will talk about in coming slides. So this is how we post the entries from journals, right? Any question regarding this entries? Chandra, Min, Ronnie, Christine? No? Okay. Because similarly, the same you will be, transferring with the working progress entry. One thing, where this balance came from, the question itself mentioned the balance here. Okay, the beginning balance. So why this balance is a debit balance? Why? Because working progress is on asset, and normal balance of asset is always debit. If they want to give the credit balance, they will, mention it that this belongs to asset, but its balance is credit balance, right? If nothing mentioned, then use normal balance. Asset normal balance is increased balance. Increase mean debit. Liability normal balance is increased balance. Liability increase credit. So normal balance of liability would be credit balance. Similarly with the owner's equity. Okay, now apply overhead cost to working progress using predetermined overhead rate. That is very important one. Now this is the crux of why we are using this applied overhead rate. We know the logic. because we first secure the order and then we start producing the order, and then we keep track on our cost, whether we quoted the price and according to our predetermined prices, forecasted price or not, right? What if these two doesn't match, which normally we are not, we don't have any godlike abilities, we cannot predict futures, right? Sometimes the cost is, we underestimated the cost or we overestimated the cost, right? So we'll talk about, and we'll talk about that, and then we adjust as well. So let's talk about this. So okay, here we go. If actual and applied manufacturing overhead are not equal, then it means our predictions are not according to our outcomes. You understand what I'm saying? Chandra, Min, Christine, Arone? We predict that. Okay, here we go. We predicted that applied manufacturing overhead would be 200,000, and our actual 180,000. So, so this concept is very simple. Most of the students are confused here, what's going on, and where this terminologies came from. Very easy. We applied on the basis of machine hours, labor cost, whatsoever. The answer is 200,000. That is our estimated answer, applied answer, forecasted answer, right? But our actual expense is 180,000. So did we overestimate or underestimate? Chandra, Min, Aroni, Christine? Over applied is greater than the actual. It means we overestimated or over applied, right? Girls, I need your participation because this is very small and but